It's Thursday, 26th of March, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, why the UK government has been getting the least love from investors in the Iran war sell-off. But first, Group Chief Economist Neil Shearing is with me to wade through another week in macro and markets. Hi, Neil.
Hi, David.
We are recording this just after 9 o'clock London time on a Thursday morning. It's a week that started with war on, then Trump hits Truth Social, basically says the war's on hold, talks with Iran going very well, but then the Iranians deny the talks, but now it seems they're open to talks, but Marines are heading to the Strait of Hormuz anyway. It's exhausting, isn't it?
It's completely exhausting. It's obviously repeated the pattern that we've had over the past several weeks. And markets have been on that proverbial roller coaster. Now, obviously, our job is to try and step back a bit and try and think through the scenarios. That's exactly what we've been doing in our latest global economic outlook that's just been published. But that lays bare, really, the fact that so much of the global economic outlook now hangs on just what happens in this conflict.
As you say, yes, the Outlook was published yesterday. We came into 2026 with this line about the global economy muddling through, US, India outperforming, not much else really to write home about, but disinflation still happening, major central banks mostly still in easing mode, but more than expected in the UK and Europe, perhaps less in the case of the Fed and the BOJ doing its own thing. Then along comes this latest shock to the global system. And I do want to talk about this idea of a shock to the global system in a bit. But along comes this shock to the system, this conflict in the Middle East. And as you say, our new macro and market forecasts are out. They pin down how far we've moved from that previous world, our previous expectation coming into this year. So obviously, an awful lot to unpack here, but just give us a sense of the distance that we've traveled between where we thought we were heading in 2026 and now, because of this conflict, where we think we're heading now.
Well, again, it all depends on exactly how the conflict plays out to a large extent, but not exclusively how the conflict plays out. There are other factors we need to consider. Broadly speaking, when talking through the consequences with clients, we've pointed to 5 things that will shape the economic impact. At the risk of stating the obvious, is the duration of the conflict, and specifically the duration of any de facto closure of the Strait of Hormuz and the associated disruption to energy supplies, the degree to which each economy is a net importer or net exporter of energy, Asia, Europe more exposed than the US, Canada, Norway, Russia, potentially winners in this. The oil and gas intensity of GDP, so how many units of oil and gas is required to produce a unit of GDP. That's a lot lower than was the case in the 1970s. That's an important distinction with those oil shocks of the 1970s, but is higher in the US, for example, than is the case in China. Then we need to think about the fiscal response. Do we get fiscal support packages like we had in 2022? And the monetary policy response as well. In 2022, we had that very aggressive tightening cycle that followed the energy price shock because we had a surge in inflation. Do we get a similar response this time around? So lots to unpack there. They're the determinants of the economic outlook, though, when we think about the impact of this conflict. Broadly speaking, if the conflict proves to be severe but short-lived, perhaps easing over the course of April such that the strait is starting to open by the end of next month, then it will clearly push up global inflation. It's going to trim global GDP growth. Broadly speaking, the fallout's manageable, I think, in that scenario. Most central banks probably look through that shock. The ECB might be an exception, but most central banks look through it. Clearly, though, if we have a more adverse shock, a longer lasting conflict through the first half of this year, perhaps it's more difficult to get Iran to agree to terms of a ceasefire, which certainly looks possible at this juncture, then the economic implications are more significant, potentially in our adverse scenario, consistent with most definitions of what people would think of as a global recession.
Yeah, we were doing a client briefing earlier today. Someone asking specifically about, are we in this more adverse scenario that we've mapped out? And if so, does that mean it's a global recession? And I think your answer was, we're not there yet. In the event that we are in this adverse scenario, yes, it would, all things being equal, mean global recession as we measure these things. But as things stand, our baseline, there's that show Chernobyl, there's that line, not great, not terrible. And that would seem to capture where we are in terms of how our baseline scenario looks, where there's some fallout in terms of growth, in terms of CPI, but in 2027, the global economy is coming back from that. I mean, you mentioned there the ECB. Where do we see the pain being felt more, even under this baseline scenario?
Well, broadly speaking, in Asia and to a lesser extent in Europe, these are the countries that are the big net energy importers. We're seeing the pain spread already through the refined products markets. We're seeing some relatively large moves already in products like gasoline, jet fuel in Asia specifically, and so that's where we're starting to see the pain come through. Europe, of course, is also vulnerable by virtue of the fact it's a net energy importer. It's the gas market again that's the issue with Europe. We've seen that strike on the Qatari facilities last week has knocked out, according to the Qatari authorities, 17% of gas production. It's going to take several years to repair. That, I think, and that's fed through into European natural gas prices, because now Europe and Asia are effectively having to compete more intensely for LNG that's on the market. So, short answer to the question is Asia and Europe. We're seeing it first come through in refined products in particularly in Asia and Southeast Asia, and then in natural gas, which will eventually start to, if these prices are maintained, start to feed through to energy bills in Europe later this year.
You talked about market pricing there. What about in terms of the economic data? Are we seeing any signs yet of how this conflict is affecting activity?
Well, it's still early days, and it will depend a little on when these surveys are conducted, as to the extent to which they pick up any shift in sentiment caused by the war. We are starting to see some weakness, particularly in the business surveys in Europe. So we had earlier this week, we had the IFO survey from Germany. That was soft. It was soft across the board in March. We've just had some consumer sentiment numbers from Germany. They've been weak too. We'll get consumer confidence from the UK later this week. That might reveal some softness as well. So we're starting to see the first signs of evidence that this is denting sentiment, but it's, as I say, it's still early days.
This is shaping up, really, isn't it, to be the central bank dilemma that you've been talking about, where surveys are showing some softness already. Once we see that feed through to hard activity, if we see that beginning to worsen, but you've got rising inflation because of what's happening with energy prices, central banks are then going to be faced with that challenge, aren't they?
Exactly. The essence of the challenge facing central banks is how do they weigh, on the one hand, the fact that higher energy costs is going to squeeze real incomes, in particularly for households, and therefore demand, against the higher inflation caused by those higher energy costs. So it's a stagflationary shock. It's a supply side shock. There's not much that monetary policy can do. They really have to think about anchoring inflation expectations in these circumstances and making sure that doesn't feed through into second round effects to broader wage and price setting behaviour. In all of that, labour market conditions are crucially important, critically important. The extent to which the labour market is perhaps a bit looser now than was the case in 2022, I think will be helpful, and is one reason why we won't get quite as big a monetary policy response this time around. Clearly, monetary policy in a different place too. Back in 2022, extremely loose. Now, not the case. It's a bit more neutral. But I do think that most central banks are going to try to keep policy in a kind of neutral to restrictive, moderately restrictive range through this shock because of the experience of 2022, and not wanting to kind of be caught on the back foot again.
And through all of this, it's key to make sure that inflation expectations remain in place. They don't start rising because consumers, businesses see what's happening with energy prices. So talk about the risks around that.
Well, the critical thing is not just inflation expectations, but also how any shift in inflation expectations manifests itself in the labour market. Because, of course, we might expect inflation next year to be 10%, but it doesn't make much difference. We can all expect inflation next year to be 10%. The key thing is, will our employer, is Capital Economics, going to give me a 10% pay rise on the back of that? Now, in 2022, the labour market was particularly tight. So as we started to see inflation expectations shift up, some evidence that this was feeding through into to second round effects through higher wage growth. This time around, labour markets, particularly in Europe, particularly in the UK, I know you're going to talk to Ruth Gregory later in the podcast, but the labour market's not quite as tight. So that helps to mitigate, I think, the second round effects through wages. So it's not just a shift in inflation expectations, it's also the extent to which that then feeds through into wage setting behaviour, the extent to which workers are able to bargain for higher wages.
And that's why we're not expecting the kind of reaction then that we saw.
It's one reason. I think, as I said, the other reason is that economies are in a different place in terms of the cycle compared to 2022. Monetary policy is in a different place too. So nominal interest rates back in 2022 were close to the zero bound. Real interest rates were negative. That's not the case, certainly with nominal interest rates now. So central banks don't have to tighten quite as aggressively just to kind of catch up and get back to neutral. They're already broadly at neutral.
At the outset, I called this a global shock. Your note this week, you put out earlier in the week, it was about how policymakers and investors need to pay far more attention to vulnerabilities on the supply side of economies in this more dangerous world that we're living in. And it's striking because, as we said, that the news flow of the past month has been exhausting, but if you take a step back, you can see this war and its disruptions in the context of a series of blows that's been happening to the global system in recent years. So talk a bit about that context, talk about how what's happening in the Middle East fits into this pattern and what that says about the global economy.
Yes, it's striking when you look at the global economy over the past decade, how the supply side has started to matter much more. I mean, for the last 30 years, certainly through the 90s, 2000s, when I was training in the 1990s as an economist and then started in the early 2000s at the UK Treasury, no one really thought about the supply side of the economy. It was all about kind of demand side management. And to the extent the supply side mattered, it was all about making sure that the focus was on creating conditions that allowed the most efficient allocation of resources. So globalization, supply chain integration, labor market deregulation, et cetera, et cetera. If you think about and the big shocks to growth that we had through the 90s and 2000s were all about the demand side. So in the early 1990s in the UK, the dot-com bust in the US in the early 2000s, and then the biggest of all, the 2008 global financial crisis. That was all about demand weakness. Since then, the supply side and supply side interruptions have become a more frequent source of economic dislocation, if you like. That started most obviously with the pandemic, the COVID pandemic in 2020. But since then, we've also had Russia's invasion of Ukraine and the energy shock that followed from that. We've had blockages in the Suez Canal and the Red Sea. That created a much smaller economic shock, but still some impact on supply chains. We've had the politicization of trade policy and through tariffs and in this Trump administration. And now the war in Iran, and underpinning all of this, of course, is the fracturing of the global economy, as we've called it, this fracturing of the relationship between the US and China and the deepening of a superpower rivalry and how that's reshaping supply chains. So the short point being that supply side interruptions are starting to become a more frequent source of economic shocks. And that requires policymakers to adopt a different mindset when thinking through about both how to respond to those shocks, but also how to make economies more resilient.
You mentioned blockage in the Suez Canal. This week actually marks the 5th anniversary of the Ever Given cargo ship getting stuck in the canal. You talked there about policymakers, governments, how they have to learn to respond to shocks, make economies more resilient. What would those response mechanisms look like? How do you build resilience into economies?
Well, I think the first point is to try to identify single points of failure, choke points, if you like, within both the global system, but also individual economies. Governments have started to do this, to start to map these things out, but there's still a lot more work to be done. Clearly, within trade routes, there are obvious choke points: the Strait of Hormuz, the Red Sea, the Malacca Straits. These are the Panama Canal. So thinking through kind of the resilience of supply chains through that lens, I think is important, and having kind of contingency plans. There is the supply of critical minerals that has become an increasing focus. And of course, energy is the big one, particularly in Europe. So how do European governments respond to this, now the second energy crisis in only 3 or 4 years? Is there more focus on renewables, but is that is that accompanied too by a greater effort to develop other sources of fossil fuel energy? And how does that interact with targets to green economies to push towards carbon reduction goals? So these are the kind of debates that are not really yet happening, but need to start happening. And of course, then underpinning all of this is how do you pay for it? Fiscal positions across advanced economies are pretty strained. There's not much fiscal space. We know that governments, particularly in Europe, want to increase funding for defence and spending on defence. So how do you create space for that, as well as the investment that will be required to diversify and make supply chains more resilient? Again, part of the discourse and debate that has not yet really started to happen. What are the sacrifices we're going to make in terms of other expenditure to create room for this expenditure to happen?
And if just going back to our baseline scenario, if this does turn out to be a war that lasts just a few more weeks, oil prices come back a good part of the way to where they were before the conflict, and the economic fallout, the hit from all of this turns out to be manageable, this doesn't sound like it's going to be the shock that's really going to fire up that debate, does it?
Well, I think part of the problem is that in the moment of crisis, there is growing talk of the need for resilience, the need for focus on the supply side. And then once the crisis fades, naturally that discussion becomes less urgent. But it's in those moments when the crisis has faded that actually the policy action needs to start to take place. There's lots of evidence that actually at a firm level that if firms take action to diversify supply chains, to remove single points of failure, that's done gradually, then it doesn't impose an awful lot of cost throughout supply chains. If it's done very rapidly, then it does impose costs. So it kind of comes back to this point that it's only in the heat of a crisis that the debate about the need for greater resilience really takes place. But actually the policy action needs to happen in a more gradual, more measured way outside of crises, and that will minimize the costs.
Neil Shearing there on our new set of macro and market forecasts covering our baseline and adverse conflict scenarios that's been published in our latest Global Economic Outlook. The publication is out now. It's gone to all clients. Anyone who missed it, I will link to it in the podcast notes. If you're not yet a Capital Economics client and you want the forecast, the analysis, and to discuss our assumptions with the team directly, get in touch at podcast@capitaleconomics.com and we can set you up with trial access immediately. That's podcast@capitaleconomics.com. Now, a cursory glance at the 2 or 10-year gilt yield chart shows you just how badly UK government paper has been affected by the sharp repricing of expectations since this conflict began. In fact, by some measures, the UK has been the worst performing among G10 bond markets. To find out why, I spoke to Ruth Gregory, our Deputy Chief UK Economist. Ruth's a former economist at the OBR and Treasury. She joined Capital Economics in 2015 and was just last week nominated for Analyst of the Year in City AM's annual awards. For those who don't know, City AM is a paper that's read by pretty much everyone in London financial services, so we're obviously thrilled for Ruth and for our UK team. Anyway, here's that chat with Ruth now, and it begins with her talking about why gilt yields reacted so violently to the conflict outbreak.
There are a few things going on here. I think at the short end of the curve, gilt yields have surged as expectations for rate cuts have been replaced by expected rate hikes, as investors latched onto the Bank of England's hawkish signals last week. So I think amongst developed market economies, the UK has seen perhaps the largest swing in rate expectations. Before the conflict, the markets were pricing in one 25 basis point rate cut from 3.75% to 3.5%, and now they're pricing in almost 3 25 basis point rate hikes to 4.5%. And in fact, the markets are pricing in a 78% chance of a hike at the Bank of England's next meeting on the 30th of April. So I think a key question now is really whether investors' expectations for interest rates have changed too much. I suppose the Bank of England's hawkish tone is perhaps not too surprising. It is haunted by its experience in 2022, when it was too slow to respond to the energy price shock. And being too late to hike rates is certainly not a mistake the bank wants to make again. But I think provided the conflict doesn't escalate further, we're not expecting the Bank of England to act on those hawkish signals and raise rates this year. And that's because we think the energy price shock will probably extinguish growth. It will add to the already elevated unemployment rate. And in other words, we think that investors may be underestimating the stag part of the stagflationary shock that the UK is facing, given how soft the economy already seems. And I think that's why in our baseline assumption in which the war continues, perhaps to the end of April and then de-escalates, we think the Bank of England is more likely to hold rates for a prolonged period rather than to hike rates. I think there's a couple of other things going on in terms of those moves that we saw in the gilt market. I think there are concerns that the UK is heading into this energy price shock with inflation expectations elevated, CPI inflation stuck at 3%, and that's well above the 1.9% rate that we saw in the Eurozone and the 2.4% rate in the US. Investors may be nervous about a large energy bill bailout for households, which the government arguably can't afford. And it's worth also saying that some positioning and liquidity may also be exaggerating the story somewhat here. So, for example, hedge funds had been positioned strongly in favour of gilts on the back of expectations that the bank was going to cut rates prior to the war in Iran. But when the war broke out and it became clear that those cuts may not happen, then those positions were unwound, which has likely exacerbated the upward swing that we've seen in gilt yields.
Right, there's a lot to unpack there, but it's probably worth putting some numbers on it now. You just said, inflation at 3%. That was a CPI report that came out earlier this week. To what extent is that looking in the rearview mirror? Because we haven't really had the impact of the surge in energy prices feed through. What are we expecting in terms of where CPI goes from here?
Well, I think in our baseline scenario, we think that inflation could rise from 3% in February, perhaps to a peak of about 4.7% in November. The average petrol and diesel price has already risen to 159 pence per litre. And that will probably add around 0.3 percentage points to CPI inflation in March. And based on the rise in oil prices that we've already seen, petrol and diesel prices could rise by a further 10% or so in the coming weeks to 175 pence per litre. If you look at our current working assumptions around gas prices, then that may mean that the Ofgem utility price cap may rise by 30% on the 1st of July, and that would add an extra 1 percentage point to CPI inflation in July alone. And that's even before you take into account the indirect boost to inflation from businesses passing on some of their energy costs in the prices of non-energy items. So all of that adds up to inflation perhaps peaking at around 4.7% in November in our baseline scenario. But I think with the GDP growth set to stagnate over the next few quarters, the unemployment rate set to rise perhaps to around 5.6%, that should weigh on inflation further ahead in the medium term and help to bring inflation back down again in 2027. And that does underpin our view, as I already mentioned, that the markets have perhaps gone a bit too far by pricing in a rise in interest rates from 3.75% now to almost 4.5%.
Yeah, Andrew, we were talking last week on the podcast. Andrew Bailey came out after that, the Bank of England decision, after the statement came out, markets went haywire. And he said, well, hang on a sec. We haven't, it's far too soon for us to start thinking about rate hikes. That message doesn't really seem to have got through to the market.
No, that's right. I think that the investors are really underestimating that stag part of the stagflationary shock, and the economy is going into this energy price shock. It looks pretty anemic, I think. And I think in an environment in which jobs growth is weak, vacancy rates are low, I think workers are less likely to be successful in perhaps seeking pay rises than they were when energy prices surged in 2022. I think in our baseline scenario, at least, we do think that the bank's more likely to hold rates for a prolonged period than hike them. Obviously, there are scenarios out there in which the bank does raise rates, and I think in a larger and more persistent energy price shock, such as our adverse scenario, inflation could rise perhaps to a peak of around 7% in early 2027. And in our adverse scenario, we have a mild recession in the UK and 2026 GDP growth of just 0.3%. And I think in that scenario, the bank would probably be more worried about inflation and raise rates to 4.5%. Even so, I think we are starting from a position where interest rates are already above neutral. So we are assuming that any tightening cycle would probably be small and short.
As you suggested, there could be other things going on as well, though, right? Outside of monetary policy. We went into this conflict with UK public finances in a pretty precarious situation. You've just spoken there about how growth wasn't great. It's going to be less great now because of these higher energy costs. Do you think that what's been happening in the bond market just feeds into this investor anxiety about the UK's fiscal position?
Yes, I think it's certainly a factor that investors may be nervous about an energy bill bailout for households, which the government arguably can't afford given the UK's weak public finances. I think that obviously the fiscal rules that the Chancellor has, they don't bite until 2029-30. So in theory, Reeves could announce an unlimited support package provided it's temporary and still meet those fiscal rules. But in practice, it's not the headroom that matters, but it's the perceptions of fiscal sustainability in the market. And I think even in our adverse scenario, the risk that a support package could unsettle the bond market due to the UK's fragile fiscal position would probably mean that any fiscal package that the Chancellor does announce has to be much more targeted than the package in 2022, and it might only offset a part of the economic pain.
You keep mentioning 2022 because that was Russia's invasion of Ukraine. That was the big energy spike. But something else happened in 2022, didn't it? Which may be feeding into this sort of febrile state of the gilt market. And that was obviously Liz Truss, the mini budget in sort of October, November that year. When we look at the sort of the mood in the gilt market, to what extent is there this lingering question about what's happening on the political side, the security of Keir Starmer's job, Rachel Reeves' job, lots of positioning within the Labour Party, lots of briefing in the press about key figures making moves to challenge the leadership. Is that part of what's going on as well?
Yeah, I think it certainly isn't helping, and I think the recent criticism of the Office for Budget Responsibility, the fiscal watchdog, from Angela Rayner, who's the bookmaker's favourite to replace Starmer. I think that has likely raised concerns about a ramping up in government borrowing were Starmer to fall. So I think certainly the political speculation is certainly not helping, and it may be adding to nerves in the gilt market.
So pulling it all together, working off this baseline scenario that you've been talking about, where do we see UK macro by the end of this year? Where do we see gilt yields by the end of this year?
Yeah, so in our baseline scenario, we think gilt yields will continue to fall back over the rest of the year as investors unwind their bets on rate hikes. And we think that the 10-year yield will end this year at around 4.5%. I think even in our adverse scenario, which foresees the war escalating, we don't think it would get too bad for the gilt market with interest rates already above neutral. As I mentioned, we do think that any tightening cycle would probably be fairly small and short.
That was Ruth Gregory talking about why the UK has been hardest hit among G10 bond markets in this conflict and our baseline scenario for what to expect over this year and 2027 from UK macro and markets. Ruth and I didn't really get into the adverse scenario that Neil talked about. Under those conditions, we see the Bank of England raising rates perhaps to 4.5%, but as Ruth said, we're not working on that assumption and think market pricing has gone much too far on that. As I say, all of our forecasts covering our baseline and adverse scenarios are available in this Global Economic Outlook publication. It is out now. If you want to see the forecast, if you want the written analysis, you want to join our online briefings and speak to our economists, then do get in touch about trial access. Send us that email at podcast@capitaleconomics.com and we can get you set up. But that's it for this week. We will be back next week with more from the world of macro and markets. Until then, goodbye.